Good morning to our friends on the West Coast and the Mountain Time Zones, and good afternoon to our friends in the Central and Eastern Time Zones, and as well as our friends from Europe. Thank you. My name is Naveen Jaggi, President of Retail Advisory Services for JLL Americas. And it's great to have all you joining us today as we kick off 2024 with our first webinar, Retail in Real Time. Today, we have two guests. One, Tom McGee, ICSC President and CEO, and our second guest today is Dana Telsey, CEO and founder of Telsey Advisory Group. Our host today will be James Cook, Head of Retail Research for the Americas for JLL Retail. Before I hand it off to James, just a couple of comments about the eve of ICSC 2024. It's quite apparent now from the numbers we see from the fall of 23 and into the spring of 24 that we're going through quite an interesting time in our industry. We haven't seen such a contraction in retail supply in nearly 30 years. And with that comes opportunity and challenges. What we hope to do today is talk about some of those challenges and opportunities. And what our guests will be talking about is how our retailers and our investor clients both are addressing some of the opportunities as we look forward to a much more aggressive growth pattern in 2025 and 2026. So with that, and with about 55 minutes left in the call, I'd like to hand this off to James Cook. James?
Hello, Naveen. Thank you. Hello, everybody out there. I'm really excited to get this panel rolling. It's not every day we get to have such interesting and esteemed guests. And the purpose of today's webinar is to help all of you out there get ready for ICSC Las Vegas. It is the Super Bowl of retail real estate. It's coming up fast. It's less than 2 weeks away. I am very personally excited about what we're doing at ICSC Las Vegas this year. We're going to be recording the Where We Buy podcast at our booth. A bunch of episodes of interviews with some really fascinating people. As a matter of fact, if you want to hear those interviews, we'll be releasing them in the weeks after the conference. Head over to the Where We Buy podcast and subscribe, or you can find us on the web at wherewebuy.show. Check it out so you don't miss anything. We're also going to be releasing our celebrity restaurant report. We thought Las Vegas is the perfect place to do a report on celebrity restaurants. Everything from Gordon Ramsay to Shaquille O'Neal is going to be covered in this report. We're going to be releasing it at a big media event on Monday at ICSC. I'm super excited about that. We're doing a lot. We're doing this whole VR thing. So if you've been paying attention, you know there is the Apple Vision Pro, which is like the most high-tech, expensive VR goggles out there now. We're going to have those at our booth with the JLL tech team doing demos of how to use the Apple Vision Pro as a spatial computer. We're going to be partnering with the Color Factory, which is one of those immersive art experiences, to do a virtual experience with the Color Factory using the Apple Vision Pro. We're also going to have this thing where you can virtually tour, like fly through different markets, like LA, for example. So there's going to be a lot going on, and that's just at the JLL booth. There's so much more going on at the conference as a whole. So this panel today is perfect timing. We just released our new U.S. retail market report just this morning, so just a few hours ago. We'll throw a link to download that report for free in the chat. Or if you're listening or watching later, you can go over to jll.com and download that report. We learned a lot by doing these quarterly reports. And I would say, and Naveen kind of alluded to it, the big takeaway for this latest report is how leasing activity is right now. So we have this number that we look at called absorption. And basically that's just like how much space is occupied in a quarter. And that number was down in the first quarter. And we're kind of like, well, why is that? Is there less demand from occupiers? And there may be a little bit, but the real big cause for the drop in that number is supply. So right now, total retail, the overall vacancy rate in the US is only 4.1%. And what is available for lease in a lot of markets is getting snatched up like right away. So as an example, this is a chart from our report. As an example, in markets like Phoenix, Charlotte, Miami, Tampa, Florida, 49% or more of all of the available space in the last 12 months was leased up. That statistic just blows my mind. So more than, in many markets, more than half of all of the available space got leased up. So clearly, there is a big demand in a lot of places for retail real estate. And as you saw there, it's the Sunbelt markets, it's the places historically that people have been moving to. But one thing that has changed, and I'm going to ask our panelists about this, is the demand for retail space is a bit more uneven. So you've got certain retail categories that maybe a year ago were universally strong. And now we're seeing some winners and losers in those categories. And that's something that I think we want to talk about today. So enough of me. Let's get going with our discussion. I'm going to welcome my three panelists. Now, you've met Naveen Jaggi. Naveen is president of Retail Advisory Services at GL. But I also want to welcome Tom McGee, who's the ICSC president and CEO. Welcome, Tom.
Hi, thanks, James. Great to be with you.
Excellent. And also Dana Telsey, CEO and Chief Research Officer of Telsey Advisory Group. Welcome, Dana.
Thank you, James. Thrilled to be here.
Well, this is a great panel. All of you I've seen on TV multiple times getting interviewed, MSNBC, CNBC, all over the place. So it's great that we have some thought leaders and celebrities gathered here today. So thanks for joining. If you are watching live, we've got a chat room. Put your questions in the chat. We're going to get to as many of them as we can throughout our call. I thought maybe we would kick it off. Tom, I know that you've got some interesting statistics. Why don't we set the stage? Why don't we have you set the stage a little bit with where we're at right now?
Sure. Well, thanks, James, and good day, everyone. It's great to be with all of you, and I look forward to being with everyone at ICSC Las Vegas in just a few days. About 10 days from now, as James said, we'll have about 25,000 people there, and a lot of excitement. And I would say, just entering into these slides, if you would have closed your eyes and assumed where the retail real estate industry would have been exiting the pandemic, you probably wouldn't have assumed it'd be in the space it is today, which is a very strong position. It's in a strong place, and the demand for physical space is at very, very strong levels. However, we're living in a very uncertain economy, as Naveen referenced in his opening comments. And what I thought I would do is just kind of talk about that journey a little bit to tee up the conversation. And maybe the starting point is, where we were at the pandemic, at the beginning of the pandemic, and kind of where we are now, and really two verticals at a very high level, the economy and the consumer. And of course, we're the ultimate consumer-facing industry. So the strength of the consumer and the mindset of the consumer is critically important to our industry. First, from an economic perspective, at the beginning of the pandemic, we were basically operating in a cost of money environment. The Fed fund rate was almost zero. Today, there's a real cost of money. About 5.33%. The Fed's target rate is between 5.25% and 5.5%. And while that rate seems high, from an historical perspective, it's somewhere, not super high relative to where it's been over a 50 or 60 year time period. But the acceleration of rates in such a dramatic degree in such a short period of time is significant. Similarly, rates were increased to fight inflation, and inflation was at a very high level. During the course of the pandemic, we had no inflation in this country of any meaningful or measurable amount for a long period of time. We do now, and it's moderated at about 3.5% and been sticky, and that is driving Fed policy. And I would point out this last number, the 10-year Treasury yield, which I personally believe is perhaps the most important number that we should all be looking at least in our industry in commercial real estate. And again, prior to the pandemic, barely any cost. Today, 4.6%. That number, right, as on this slide, is a little higher than it actually is at this point in time. It's decreased by about 15 basis points since the timing of that slide. I would say if that number gets over 5 and stays over 5 for a reasonable period of time, that could cause some challenges of significance in the economy. So much debt is tied to the 10-year Treasury and the cost of 10-year Treasury. From the consumer standpoint, obviously at the beginning of the pandemic, huge unemployment as we were dealing with stay-at-home orders, et cetera. We're now at a point in time where we have historically low unemployment levels. Personal savings rates, however, have been depleted. They were at historically high levels during the course of the pandemic because for obvious reasons, people were staying home. They couldn't go out and spend. Those personal savings rates have significantly been depleted. But because of unemployment, consumers have continued to be quite resilient in their spending, and we've seen the consumer be resilient in the corresponding increase in retail sales over the last couple of years. Consumer confidence at 97, based on the Confidence Board's number. However, that number is decreasing from where it was, about a year ago, and we're continuing to see a stressed consumer, and I know we'll talk about that over the course of the conversation, but still a resilient consumer, although a stressed one, primarily stressed because of inflation and the cost of capital today. If you can move on to the next. However, we're going to be at ICSC Las Vegas, and one of the primary reasons people are at ICSC Las Vegas is to talk about deals and to talk about leasing. And as Naveen and James both mentioned, we are at a point in time where the supply of retail real estate is really not sufficient to meet the demand for space. And why is that? If you look at over the course of the last 15 years, since the great financial crisis, retail sales have almost doubled in this country, increased by 88%. Real GDP's gone up by 33%. The U.S. population's gone up by 11%. But shopping center GLA has only gone up by 6.8%. So despite significant increase in retail sales, despite increases in the economy, you haven't seen a corresponding amount of new retail square footage put online. There's a lot of reasons for that. But two we were living through a retail apocalypse to some extent, the narrative around that, although there really wasn't a retail apocalypse, and that maybe we could talk about that. But certainly there was not an appetite for a significant amount of new construction. And today, the cost of capital, the cost of labor, et cetera, is going to put some moderating impact upon new construction. So you're really not seeing a lot of new supply put on, while retailers are not only using their stores for traditional shopping reasons, but also as mini fulfillment centers, really that convergence between the online and digital worlds. And so that has resulted in very strong occupancy levels. If you go to the next slide, and as you can see from over the course of the last couple of years, we're really back at where we were in the open air space, pre-pandemic levels. The mall space is continuing to improve. Slight decrease from the end of 2023 to the first quarter of 2024 in open air, but that's a temporary decrease because that's really the byproduct of the Bed Bath & Beyond space and so forth, and some other things being open. But if you look at this at the end of the year, I'm quite confident that 92.6% will be somewhere in the 94.5% to 95%. That's a lot. That's a very strong occupancy number relative to an industry the size of our industry, which is significant in every community across the United States. The mall number obviously is continuing to improve as well. The mall conversation is more nuanced. You obviously have in some of the upper end A-class malls, there's really no available occupancy. In some other malls, there's more challenge. So it's a more nuanced conversation. Suburban open air retail, particularly grocery anchored retail, is on fire right now. And if you turn to the next slide, however, one of the things that will also be talked about at ICSC Las Vegas is transaction activity, the buying and selling of property. And because of the rising cost of capital and really some uncertainty as to how to value property in this environment, what you're seeing is transaction activity has really decreased significantly, particularly in 2023 compared to 2022. If you disaggregated that 2022 number, really in the second half of 2022, you started to see as rates went up, transaction activity was going down. That's continued in 2023. We're seeing some signs of improvement in 2024, but still it's a challenging transaction environment with rates where they are, and really the expectations of buyers and sellers haven't really lined up yet. And so transaction activity is not where we would ideally like it to be. And one of the reasons for that, and I'll leave with this final slide, is the office market. And there is, while office certainly has an impact upon retail and central business districts, et cetera, the broader narrative around commercial real estate is influenced by people's perception of office. And what you see here is Castle Keycard data for Wednesday's average occupancy since the beginning of the pandemic through April of 2024. And you can see a steady improvement from 2020 to 2021, 2022, 2023. We're kind of plateauing in 2024, still a little improvement. But clearly, people's work habits have changed. The use of office has changed. And that is creating some valuation challenges in commercial real estate in general, appetite for banks, and a negative halo that does impact transaction activity in commercial real estate in general. So I wanted to park those things just from a broad level, James, as we have a conversation today. So thanks for the opportunity to do that. James, you're on mute.
Oh no, I did it. You guys, I just have to say, the last thing I said before we went live was, now be sure to take yourself off mute when you talk. And then I did it. Oh my gosh. We are having questions coming in fast and furious. We're going to get to as many as we can. Not quite yet, but in just a little bit. I think the first thing I want to do, or the next thing I want to do, is, Dana, ask you about the consumer. You've been talking about this squishiness, and I need some definitions around this. So tell me about this.
Well, thank you very much for having me, James. Yes, I look at the consumer trends right now, and they are squishy. And what I mean by the word squishy, I'm not seeing them decelerate greatly, but they're not accelerating. I'm seeing fits and starts. I'll give you some examples. The consumer's healthy. We've seen all the metrics out there of wage growth and what's happening with labor. But yet you get some of the credit data points lately, and they're more concerning. I hear about delinquency rates that are growing. And like Tom mentioned, the savings rate now is down to around 3.2%, and it keeps coming down because everyone spent their stimulus dollars. At the same time, we're also seeing, when you think about the tax refunds, that is an offset, but maybe not enough. What I'm seeing being the sales driver, it's all about product innovation. Every single company, whether it's from the Nikes of the world to the grocers of the world, give people something new and they'll spend because they're definitely being more discerning, more cautious, whatever word you want to use, they're more careful about their spending. So, for example, a company like Lilly Pulitzer, who many of us know, and they have collaborations. What if I told you that the collaboration they most recently did, the highest price item was like a $650 dress, and that sold through very well? The reason why? Even though it's higher priced than many other things out there, it was something new and different that people didn't have in their closet. Take a look at other things that are having in apparel. We're having a Western denim moment, and who would have thought that Levi's would have a song named after them in Beyonce's latest album? And all of a sudden, globally, you're seeing denim industry trends now going to flat instead of being down. So product innovation is definitely a sales driver. At the same time, we do have inflation easing, but it's not enough. It's still taking a bite out of discretionary spending. And you don't see that anywhere more so than in the food category. And what's happening with food spending out there, specifically from consumers of lower to middle income levels, where they're managing carefully and buying cautiously. But at the same time, inventory levels are clean. While we're going into first quarter earnings season now for the retailers, that'll frankly hit nearly a crescendo as we are at ICSC in Las Vegas, although TJX reports right the next day. What you are seeing is inventory levels are down for the most part year over year. Retailers are definitely monitoring and managing their promotional levels more carefully. Yet the price increases that were taken during supply chain disruption a year or two ago, some of the retailers have rolled back those prices in order to be able to drive more sell through. And let's talk about what we're seeing by income levels because it does differ. On the lower income side, we're definitely seeing that tightening of the purse strings. We're seeing that those low income consumers were hit by the cuts to the SNAP benefits, yet they had a 4.5% increase in the average tax refund to $3,000. So that's a benefit. But they need that because when you have a wavering of gasoline prices out there, maybe now a little bit more stable, yet we have the summer still ahead of us, there is more daily expenses that they're needing to manage through. The middle income consumer, you're definitely seeing middle income aspirational consumers curtail their spend. And you're seeing that, for example, in some of the accessible luxury markets that we track. We're seeing the focus on value retailers, whether it's discounters and off price. And I know we're going to talk more about them, but the share gains that they're getting, both in traffic and in sales, and the customers that they're attracting because of the better assortments they have, we're going to see continued strength out of the off pricers and the discounters. And let's talk about high income consumers because we've had many of the luxury brands report their sales recently for the first quarter, and they're still spending, but they're diversifying some of their spend to travel and experiences. You look at what American Express just called out on their first quarter earnings call with an 8% increase in travel and entertainment. And part of the reason why, experiences create memories, and we need more memories or to load up on memories after what you had during the pandemic. And for some of these memories that are being created, it also creates a little bit more discretionary spend from higher income consumers. So they're spending, but they may be diversifying their spending. As we go to the next page, on category insights and what I'm seeing out there, let's talk about the month of April. We had the beginning of the calendar second quarter definitely being impacted by an earlier Easter and cooler weather. Take a look at New York, where, frankly, in New York on Saturday and on Sunday, it was in the 50s. Typically, what you would have thought at the beginning of May, it would have at least been high 60s to 70s. I'm seeing wholesale channel orders for apparel goods improving. Overall, discounters, we're seeing improved orders. You look at companies like the Steve Maddens of the world, and orders from both Walmart and Target have picked up. You look at off price retailers who now, for many apparel brands, the off pricers, whether it's TJX, Ross Stores, or Burlington, they are apparel brands in their top 5 customers. While we're continuing to see the more careful and cautious ordering by department stores, both in the US and in Europe. And we're seeing the lower income consumer shoppers on the apparel side shop closer to need. And the reason why, even take a look at Easter. You can get more deals the closer you shop to need, and they're definitely more mindful of what their spend looks like. Let's talk about beauty. Definitely the bell was signaled just a couple weeks ago when Ulta talked at the beginning of April that they're seeing a moderation in beauty spend. And then you had some of the Circana data who also verified that, saying that the growth rate in beauty in both mass and prestige offerings is moderating and slowing in 2024 as compared to 2023. It's in North America. The category that in beauty that has seen the most slowdown is makeup, with fragrance definitely performing better. And we're also seeing luxury beauty soft in China. When I think of department stores, they're updating their assortments across both national brands and private label. You can see many of the new private label brands that a Macy's has introduced recently, for example, in intimates. We're hearing of more collaborations from the Nordstroms of the world in order to be able to attract a younger consumer to department stores. And enhancing the store environments is part of that. Reinvesting in the store environment in order to drive socialization and create that entertainment experience is what we're seeing department stores work to return to. You're seeing it in Bloomingdale's with a lot of newness, and now we're seeing other department stores work to reinvigorate their sales increases and traffic. And then when I think about discounters, overall, they're getting the traffic. you're seeing certainly more private brands come into the discounters more than we've seen in the past. You look at Diane von Furstenberg with Target that gains certainly big acceptance, and you're seeing new food brands that are private label being introduced at Walmart. So they cover the assortment of categories that they can appeal to their core customer. I'm seeing more digital capabilities being enhanced by the discounters. AI is definitely front and center, along with automation, in order to be able to ease the pickup and offer faster delivery than it's ever been in the past. At the same time, we're seeing big remodeling programs from the discounters. Take a look at a Walmart who's doing nearly 600 stores, or you take a look at Target who's been on the path of remodeling stores, and whether it's in size of footprint or what the stores look like, ease of shopping, driving awareness and newness makes consumers gravitate to saying, I want to go to the store to see what they have that I didn't see, whether it's online or that you can create a wow factor in driving engagement. If we move to the next page, I'm thinking about grocery. And Tom mentioned grocery. Definitely those open air grocery anchored centers are all the rage. We just had a new Wegmans open up in Manhattan just a few months ago. And frankly, the traffic that you're seeing in that Wegmans, I've been there, I've seen that. The 700 store associates who work there, it's become a must to in the downtown area. And frankly, even elsewhere, as Wegmans is going to be opening another location in Manhattan. We're seeing customer data being able to drive insights and also drive media products for some of the CPG partners. I think the importance of grocery in a hybrid work environment with open air centers is something that is driving curation for that open air center too. So, food inflation only around 1% right now, so definitely still a headwind, but not what it had been. And I think the areas of fresh, natural, organic, ready to eat, ready to cook, and prepared foods is what is increasing in this new hybrid work environment at the grocers. Let's talk about home. I keep hearing the word soft affiliated with the word home. Soft in two areas: soft in terms of furniture sell through, soft in terms of projects, in term home project spending. And definitely the higher interest rates is an impact on that. If we see an easing of interest rates, I think that's going to certainly signal a pickup in home spending. Where you haven't seen a slowdown in spending is in off price. And I've always been taught that a 3% increase in same store sales and off price is the normalized steady eddy. When they get above 3%, what does it mean? They're getting the benefit of that trade down consumer. And frankly, you look at the off prices today and they're getting that benefit. There's a favorable buying environment, the accelerating same store sales, the market share is increasing with the growing store base, and with each of the off-price retailers opening up over 100 stores each, and with Burlington having acquired 64 leases from Bed Bath and Beyond, I think that off-price is becoming more of a destination than it ever has been in the past. And let's talk about luxury. The growth rate of luxury, I mean, you still have huge increases as compared to 2019, but year over year gains decelerated in the first quarter as compared to the fourth quarter. We saw it from LVMH in a big way, and you're seeing it from some of the others. You certainly need new creative products to emerge from companies like Gucci in order to be able to drive increases. And the DTC performance is definitely helping to offset some of the wholesale softness. I know we're going to get into this later, but the heritage and authenticity of the luxury brands, particularly those European luxury brands, and the cash balances that they have, is allowing them to become acquirers of real estate in order to control their own destiny, not just today, but multiple years into the future as they think of where their brand sits over time. While the aspirational consumers are continuing to remain cautious in their spending. So a real bifurcation in the spend, but you definitely have areas of opportunity where different categories are excelling and different channels are excelling. While overarching, we continue to have cleaner inventory levels that's leading to more profit clarity than sales clarity in the near term.
All right. Well, that was quite the download. Thank you so much, Dana, for all of that. I feel like we've just covered so much. I feel like I know the consumer intimately now. So I really appreciate that. Let's get in. I've got a good question here. And Naveen, this makes me think of you. Let me get this question up here. This one comes from Catherine. So I kind of quoted that the overall vacancy rate is 4.1%. She asks, what does that mean for downtown? Vacancy is higher in most downtown markets when we're talking about retail vacancy. I mean,
Correct.
the real demand is still the suburbs. But tell me, Naveen, because you're overseeing leasing in a lot of downtown
Sure.
markets. Tell me what you're seeing.
Yeah, I mean, it's a tale of two different cities depending on who you're talking about, right? So if you talk about downtown LA, it's not pretty. If you talk about downtown New York, it's better than it was a couple of years ago. Downtown Chicago's still having a slower comeback than New York. I think the New York story is really the one that we always like to point out as the trendsetter for urban markets recovery. So New York right now, if you talk to the people in New York City, whether it's the JLL folks or the REITs, they'll tell you that the average number could be somewhere around 6 to 7% vacancy. It depends obviously on the submarket. To me, that's a pretty good, healthy sign relative to where we were a couple of years ago. That still means opportunity. I think that's what we want to see is our retailers moving to the urban market when they believe there's a market for sale. They still believe that New York still has opportunities. That's also extending out to markets such as Chicago, such as San Francisco. Those are good, strong urban markets that people still believe they can find some prices, some rents that are below what historical trends would say, and get those locked up for 10 or 15 years. So that 4% number is really much more of a suburban number and much more of a Pan-American number as opposed to an urban number where I think we're still looking at 8%, maybe even 9%. If you look at some other suburban markets like Philadelphia, the numbers are not so attractive as well. So it's really quite different market to market. Urban's not back where suburban is.
Yeah, absolutely. So here's another question that came in, and this one is referring back to, I think, Tom, this is when you had a slide up. But the question, really, to boil it down, is we're seeing growth in bricks and mortar retail sales. We're also seeing growth in online retail. And this commenter was surprised that both of those are happening in tandem. Maybe, and Tom or Dana, I'll open this up to you. I'm not surprised that both online and in person is growing. I mean, people are just spending more, right?
I mean, I'll start, and then Dana can add to it. Just from a macro level, and I mentioned the narrative around the retail apocalypse. But if you went back and looked at retail sales at every year and disaggregated between online sales and physical retail sales, every year except one, both channels grew. The only year that physical retail sales didn't grow was 2020. And what happened in 2020? You had a pandemic. You had stay-at-home orders. So yes, online sales it generally grew much faster, with the exception of the 1 year post-pandemic where physical retail sales grew at an astronomical rate. But there really was never a retail apocalypse. First and foremost, retail sales always grew in store. They just grew at a smaller percentage. But what's really happened is that retailers have discovered that they're not mutually exclusive. They really need to be integrated. And it's about, there's only one channel that really matters. It's the consumer channel. How do I serve my consumer best? And so what you're seeing is retailers beginning to use their stores as traditional shopping experiences, but also as many fulfillment centers. And really they're setting up additional space within a store to fulfill online orders, et cetera. We have done what's called a Halo report, a series of Halo reports that looked at the synergy between physical and digital retail. One of the things in our most recent report is that when a retailer opened up a store in a particular area, trade area, their physical sales obviously went up because they opened up a store, but their online sales in that particular trade area also went up. On average, 6.9% across all retail types. Obviously, it differs by sector and so forth. And when they closed the store, their physical sales went down, but their online sales went down as well. And so, because it creates a legitimacy to the brand, an awareness to the brand, insight in mind, so to speak. And clearly, it helps drive online sales, and it helps, the store can be used to fulfill on those online sales as well. So I don't think it's it's an either or. I really think omni-channel has really been, morphed into one channel, the consumer channel, and you need to be good at both. Dana, I'm sure you'll have some thoughts on that also.
I couldn't agree more. I think it is omni-channel. You call it uni-channel. I think one of the things coming out of the pandemic that we're now seeing, retailers are reinvesting more in their store formats. They're reinvesting in new stores. They've adjusted some of their square footage, but the functionality of a store and the structure, it has to be able to offer buy online, pick up in store, and ship from store. And frankly, with the data and technology, and I bet you 2 years from now, we're going to talk about how AI curates the merchandise in the store and what efficiencies can be gleaned on even the labor model of the store and what you're using for online. It's about both. And I know we're going to talk about loyalty programs later also, but loyalty programs are also help to drive sales both online and in stores. It's not either or, it is both.
It's really, Dana mentioned AI, and that clearly is a enormous trend that's going to impact our industry and every industry. But there's even first of all, the pandemic accelerated a lot of this stuff. Again, if you closed your eyes, you wouldn't have thought physical retail would have emerged the way it has, but it accelerated a bunch of trends that led to this acceleration of the convergence between the two. But there's a whole lot of things that are going to happen as a result of this. The store layout has to change, right? I mean, because you're fulfilling online orders. So how a store is mixed, the curation, the merchandising mix, setup, et cetera, even parking lot, setup, right? If you're doing curbside pickup and click and collect, that's going to have, implications on traffic flow, et cetera. So we're really, in the midst of a lot of change that's taking place. And so I would encourage folks to really, be observant to what they're going to see over the course of the next couple of years as this trend really takes hold.
Yeah, and we had a question in the chat, and we've kind of already spoken to this. Is there a sense of what portion of retail space is being used, for in-store fulfillment? I think it varies by category. I think it also varies by, individual chain. A lot of times they're having to take away from something. You've got to carve out some space, for delivery, for curbside pickup. So you've got to kind of decide what category you need a little bit less of in the store. But I don't think we have any overall statistics. I don't think anybody's tracking it that closely.
I haven't heard that either. Yeah.
Yeah.
No.
Well, so Naveen, there was another one that popped up that I was going to circle back with you. And we're talking about urban vacancy again. What is driving that? So obviously, I think your point was that there is strength in leasing. And I know we talk about this all the time with our peers, all the activity in New York, San Francisco, places like that. But still, vacancy is higher. So what's driving that in your mind?
Okay, so again, a multi-layered question with a multi-layered answer. If you just think about what Tom talked about earlier, and we've talked at length about, as you did as well, about the Sun Belt region of America growing at a greater share than it's called the Rust Belt or the Northeast. Well, most of the Sun Belt cities are not an urban-oriented city map out. So if you look at Houston, Dallas, Atlanta, Phoenix, other major markets like Orlando, they're not really high-dense urban markets. We're seeing a greater move of people into those markets. Texas is seeing over 100,000 people moving into Houston and Dallas per year. Those are not urban markets. So if we just look at the isolation of just urban markets in America today, key urban markets, it's really about 4 or 5 cities that I would call and define as really strong urban cities, right? So Miami, New York, obviously, Philadelphia to some degree, Chicago, San Francisco, maybe to some degree Seattle. So we just don't really have the same type of urbanization as we used to, because as the American population has moved to suburban and to the Sun Belt, it's less urbanized. As a result, we're seeing greater absorption of retail space where in the suburbs of these kind of non-urban markets. And so retailers now are saying, where do we move to have the quickest opportunity to open a store and get that store up to deliver the ROI that we want? And in some of these states, in the Sun Belt regions, we just have a quicker life cycle to get that store open from permitting and opening the stores. I've heard stories where it can take up to 900 days for a retailer to find a location and get it open on the West Coast or the Northeast. That same retailer will take 300 to 400 days to open in the Sun Belt region. So as a result, you can imagine that the absorption of and the quickness to move to those markets will drive retailers to occupy space faster in the Sunbelt region.
Yeah, absolutely. So Dana, you brought up something, and maybe we can talk about this impact of loyalty membership. Has that changed recently?
It has. I mean, one of the things we're seeing is that coming out of the pandemic, retailers retooled their whole marketing buckets, and loyalty is one of those. You think about the number of loyalty members that some of these retailers and brands have. It's extensive and significant. Whether it's Bath and Body Works, who just started their loyalty program over the past 2 years, now is sitting there with around 43 million loyalty members. Lululemon just started their loyalty program last summer. They're sitting here at 17 million members. You look at Target and the Target Ulta partnership. What did they each want? They each want more of their members. Target has 75 million members in their loyalty membership program, and Ulta's sitting here at 40 million. When you think about those numbers, what are they learning from these loyalty members? What do they like? They can capture more wallet share from that core consumer, and you want to get them to make more frequent trips into your store and spend more when they're there. So I think we're only going to hear more about loyalty programs and more offers being made to make the wallet share and mind share more significant.
Makes perfect sense. I'm a big fan of loyalty membership, the discounts, and the my local butcher has a loyalty club that I don't know, every $100 you spend on meat, you get $10 off, something like that. So it's fantastic.
Early access.
Yeah, right. Exactly. Great comment from Tom, pointing out Wayfair has got a new store that's opening in suburban Chicago. Great example of online coming to offline. And I'll be curious to see. Dana, have you heard anything about that store?
No, I'd seen their store when they opened their first store in the Natick Mall in Boston, and I know they wanted to retool it, but I've certainly have heard that it's going to have an extensive offering, and I can't wait to see it also. Your comment about offline opening stores, I'm seeing that too. You look at Figs, which is a healthcare scrubs company. They opened their first store in Century City, and now they're going to be opening a store in Philadelphia also, which Philadelphia, you never would have known, but 1 of 6 medical professionals are in Philadelphia and in that whole area. So I think capturing that customer is key, and we're going to see more of these DTC companies open stores. Look at Lulu's Fashion Lounge, who opened on Melrose Avenue in Los Angeles. They need that activation and awareness.
Yeah, makes sense. Well, here's a question that came in from Jeff asking about footprint sizes. I would say, and I do have some data on this, but it's not in front of me. I would say we're seeing tightest in like the small and the large, and it's kind of the middle size that there's a little bit more availability because of less demand. Is that, Naveen, is that fair to say from your experience?
I'll tell you an interesting stat here that kind of shows kind of the direction we're going through right now. So at the end of 23, what we saw was that the overall transactional volume in terms of commissions had contracted by about maybe 10, 11%, but we hadn't seen a contraction in transaction activity. That was only down 3 or 4%. And as you know, we've talked about this through the first quarter of 24, we're seeing transaction volume down about 11% as well now. So what we're finding out is that as we talk to our retailers, find that 30, 40, 50,000 square feet space and greater is becoming harder and harder and harder. If you talk to our retailers that use that space, whether Dana's retailers, Burlington, and many others, unless you have a Bed Bath & Beyond opportunity, or Tuesday, or a Party City, or the forthcoming next one that will happen, there's not a whole lot of supply coming out there. We saw the stat recently of the 15 million square feet that we brought to market in they're bringing to market in 24. Only 14 million of that is available space. The rest is pre-leased. That just tells you that we just don't have that much space out there. And usually it's that larger space that you want, the second generation space. So whether it's delivery of space or the second issue, which is Tom alluded to a while ago on his slide, capital market volume is down to a 12-year low. When you have capital market volume down to a 12-year low, you don't have the turnover where investors will invest in making space available when they buy a shopping center. So those two things have conspired together to make it really hard. And it's in that 30, 40, 50,000 square foot space we're seeing the biggest challenge.
Yeah, that makes perfect sense. So, Tom, this next question that came in really made me think of you. I think about ICSC has really done a great job of doing outreach to small businesses, small retail businesses. So, what's your take on the topics that we're talking about? How do they impact small boutique retail?
Well, first of all, thanks for making reference to, we do have a small business center, and for any of your small business friends out there, please utilize that. There's a whole host of information that we've aggregated for small businesses. Look, I think I think shopping center landlords really want to have local businesses within their mix, right? I mean, that's really important to build a relationship with the local community. And so I think this, this focus upon really customer intimacy, customer experience, et cetera, plays to that local small business. The flip side of it is, the conversation we're having with just lack of supply, right? I mean, the competition for space is going to be fierce. But I think the environment for small businesses within shopping centers is a positive one. And shopping centers really, if people think about the stereotypical small business in the United States, the first thing they think about is a small retailer or a small florist or a small restaurant or something of that nature. And where are they all populated? They are in shopping centers, right? So it really is an incubation center for small businesses in the U.S. I would think the challenge is really for small businesses have to do with, specifically to the industry, just space. And competition for space. Specific to the economy is just the inflationary environment and cost of capital, et cetera, which is relevant to all businesses, not just small businesses.
And James, if I just take on what Tom just said, I think it's important. I can recall during the pandemic talking to 2 or 3 of the biggest REITs and developers I know in the Southwest, and almost to a person, they said that for them, when it came to working with challenged retailers to keep them alive during the pandemic, which at that time we didn't know how long that was going to last. To a person, they said they were mostly motivated to ensure the survival of the local boutique. For them, that local boutique was the one that gave that shopping center a unique character, a differentiator between another powering center, another shopping center. I think there's a lot of power, whether it's at the ICSC level or at the local developer level, to do what they can to keep those well-run boutiques sustained and alive, because they do add value and local color to make one shopping center look different than the other.
Naveen, that is such a good point. When you're thinking about merchandising mix, and as all of us who travel a lot on this call, you'll go to one shopping center and you'll be like, wait, what even state am I in? But then you'll go to another one that has these great local restaurants, boutiques, retailers, and you're having an authentic experience in that specific city. So I'm a huge fan of local businesses and local restaurants. So I keep being reminded of, we have the smartest audience. We got this question in, savings. Credit card debt is up. Savings went from 30% to 3.2%. What are our thoughts on consumer spending in the next 2 to 3 years? Let's get the crystal ball out there. Maybe, I don't know, Dana, do you have thoughts on this one?
Yeah, I mean, overall, when we heard Jay Powell in December talked about the potential for lower rates in 2024, the stock prices of all these consumers all zoomed right up, because lower rates, and we're an early cycle group, definitely would lead to greater spending, especially when housing is everyone's biggest ownership tool. And if interest rates would come down, that would certainly be better. Over the next 2 to 3 years, if we're headed into a lower rate environment, that could only be positive for consumer spending, along with the strength of the labor market that we're seeing now. And if inflation moderates, that is a good setup for consumer spending. And hopefully we'll be past an election season, because the combative election season with geopolitical headwinds makes everyone a little bit more cautious.
Yeah. Does anybody else have a take on election impact on consumer? I keep going back and forth on this one.
I mean, just my take here is that I think the markets and the U.S. consumer don't like chaos. Whether it's left or right doesn't matter, as long as it's not chaotic. And I think, to me, that the best thing that can happen for us, and from a consumer standpoint and from an equities market standpoint, is that we have have a clean election cycle in the fall. You have that, I think the markets will adjust and bear whichever party takes it over. But if you have a chaotic, contested, and it just become a prolonged environment, I think that's where the U.S. consumer starts to pull back, like they have historically during election year anyway. They get a little cautious, and if you add to that a little more of this unknown quantity of chaos, I think that will drive even more conservative behavior by our consumer and by the retailer.
That's a great point.
Yeah, I don't really have anything other to add. I think Dana's terminology of, we have a squishy consumer is a good one, and I just think there's a level of uncertainty. I would generally think that if rates go down, inflation goes down, that's a good thing. And quite frankly, we're at historically low unemployment levels, right? So generally speaking, if you look back at history, when you have a good employment market, retail sales are generally pretty good. And so if we continue to have a strong employment market, even with other factors, you're probably going to have a strong retail sales environment. If the employment pictures begins to change, that could obviously change the dynamics around consumer spending.
And to address Dave's question around credit card debt, I think we just saw this morning reports coming out that the consumer credit card debt and the overall debt of the consumer has cooled off from the previous couple of months. And so I think there may be a sign that we're seeing of consumers finally cooling off, which is what the Fed wants to see if they're going to start reducing rates. So if the question asked by Dave White, we may start seeing the first signs of a consumer cooling, which actually is a good thing if we want to see interest rates start dropping.
Yeah, that's a great point. Here's a question, Naveen, you can probably speak to this, but maybe somebody else can as well. International retailers coming to the U.S., what's the trend around that right now that we're seeing?
Well, there's a lot of interest in the U.S. because I mentioned a while ago, markets like San Francisco and New York and Chicago are available. There's available space. There's vacancy in major markets, major blocks, major submarkets, and there's a feeling there's a deal to be had. Now, on the second hand, which is the days of retailers coming here and opening lots of stores real quickly, those days are over for us. I think we're not going to see any major global retailer make a big play to open up 50, 100, 150 stores in a quick flash. So the U.S. is always has been and still is perceived as the biggest market for international retailers to grow, and that won't be slowed down anytime soon. So the interest is there, the market interest is there, the cities are there, the healthy consumer is there. But the ability to capitalize on all that with a high volume of openings is one that you likely won't see. So as we continue to see retailers from India right now looking at the U.S., for example, as well as Asia and the U.S. and Europe in the U.S., don't look for this to be turning into a massive wave of European and Asian retailers coming here by the growth.
Yeah, that is a great point. Well, we have a few more minutes, so I'm gonna throw out this question, and well, I'm going to change it a little bit here. The question from Jason is, who's the most innovative retailer out there? I don't think there is any one, but does anybody, and Dana, maybe you're a good person to ask this first, have an example of a good retailer that's doing something innovative?
I mean, I think we're seeing a lot of retailers do different things that are innovative. I think look what food has done to basically enhance sales of an existing store, whether it's the Marlin Bar at Tommy Bahama, the RH restaurant that you have of Restoration Hardware. I think the other one that's doing interesting things, look at Dick's House of Sport. When you think of what they're doing and generating significant volumes, they're having activity-based activities in their store, or even hosting hockey teams, whatever it may be there. But the engagement of doing with the engagement of buying, and the vendors who are selling into that house of sport are giving them a better assortment that's more differentiated. So I like what I'm seeing from Dick's House of Sport. It's exciting, it's interactive, and it attracts multiple generations.
Yeah, absolutely. I think that's a great example. One of our viewers recommended TikTok Shop as I'm not personally a customer myself, but I recognize that it's innovated and it's certainly capturing the young market. Well, we're just about out of time. I think we should do one more wrap up question. Maybe something a little bit more fun. So we're all heading to ICSC Las Vegas very shortly. what's something that you're looking forward to in your visit to Las Vegas? Tom, I'll start with you because it's your show. You're just going to be working the whole time, right?
Well, honestly, what I look forward to is just the energy that is there. I mean, when you walk the floor, particularly Monday, when it's opening and everybody's excited to be there, that energy level is infectious. And so that's what I look forward to, because it really motivates you and it gets you super excited. And so that is what I'm looking forward to the most.
Excellent. Dana, anything you're looking forward to?
I echo a little bit what Tom says, and I also say, I look at speaking to the landlords, speaking to the retailers, what is the innovation that we're going to see in the next year? Because coming out of talking to all of them, there's a pulse that you get, and I think certainly with more demand than there is supply right now, we're going to see those retailers be more creative as well as the landlords. So I can't wait to see that.
Yeah, that's great. Naveen, what are you looking forward to?
Well, ICSC typically represents to me in the industry kind of the end of the first half, because by the time you get to Memorial Day weekend, people take a little bit of a pause during the summertime. So to me, to Tom's point and to Dana's point, a lot of energy. I'm looking for some optimism by our landlord, by our investor, by our developer clients to tell me that they now feel like we've kind of got at a level point where they have some level of predictability by the interest rates. And do they feel confident that between the cost of FF&E, the cost of labor, the cost of money, that it's now at a somewhat of a predictable level, that gives them optimism to start putting products that are on paper into action? Because I think for all of us, we do want to start seeing more product come to the market in 25 and 26. So I'm hoping to hear a lot more about sticks and bricks going up than anything else.
I love it. Well, I'm looking forward to that and so much more. It's going to be a whirlwind couple of days. Thank you, Dana, Naveen, and Tom, so much for joining me. This has been a fantastic conversation.
Thank you.
Pleasure to be with
Nate.
you.
Excellent. And for folks out there, I know we had a couple of comments about downloading slides, and if we can share those out, we're going to check on that. But I will say a couple of things. One is ICSC has tons of publicly available information on its website that you can check out. And everything that I've talked about is in our latest quarterly market report. So if you go over to jll.com and just look under retail research, you can download our latest report. And I want to say thanks to all of you for joining. Again, check out our audio podcast, Where We Buy. And at ICSC Las Vegas, if you're there, swing by our booth. I'll be out. You'll look for me out with a microphone recording a podcast. Just wave as you walk by. Have a great day, everybody.